Kohl's entered the 2020s with almost everything a struggling retailer could dream of: fully owned real estate, massive takeover interest from Wall Street, easy access to corporate borrowing, and most importantly, time. The real damage didn't come from a lack of resources. It came from how the board of directors chose to use those tools. In February 2022, a powerful group of activist investors stepped up with a massive offer, approximately $9 billion, to buy Kohl's outright. The board flatly said no. To secure their position, they implemented a poison pill, a defensive corporate maneuver designed to punish any hostile buyer attempting to acquire more than 10% of the company without the board's explicit blessing. The pill forced outside buyers to negotiate directly with the board rather than going straight to the shareholders. Fast forward just 3 years, Kohl's abruptly fired its newly appointed CEO after a mere 100 days on the job. The company's stock price had plummeted to under $8 a share. So how does a retail titan boasting 1,170 stores, an investment-grade credit rating, and roughly $8 billion in prime real estate end up in freefall? Across the country, the headlines painted a grim picture: stores closing nationwide, corporate layoffs, and underperforming locations shutting down overnight. The board had every tool a corporate lender could ask for, but they used them in the wrong order. To understand how Kohl's lost its way, we have to look at how it built its empire. The company began with Max Kohl, a Polish immigrant who arrived in Milwaukee in the early 1900s with next to nothing. In 1927, he opened a small corner grocery store. Through decades of hard work, that single store expanded into one of the largest grocery chains in the state of Wisconsin. In 1962, Max's sons decided to pivot. They opened the very first Kohl's department store in Brookfield, just outside Milwaukee. But they built it using a blueprint entirely different from every other department store at the time. Instead of anchoring themselves inside massive, crowded shopping malls, they positioned their stores right next to major highways. They priced their merchandise perfectly, below luxury department store chains, but comfortably above discount dollar stores. This convenient, off-mall, mid-priced sweet spot became the entire reason for the company's existence. In 1972, the Kohl family sold the business to Betus, the U.S. arm of British American Tobacco. Betus was on a massive acquisition spree, using its steady cigarette profits to acquire American retail giants. For 14 years, they owned Kohl's and largely left the management team alone to grow. By 1986, 4 senior executives executed a leveraged buyout to take the company back. They put up a small fraction of cash, borrowed the rest, and used the company's own financial strength to pay off the debt. At the time, Kohl's had only 40 locations. 6 years later, in May 1992, the new owners took Kohl's public on the New York Stock Exchange. The cash generated from that IPO funded a store expansion strategy so aggressive and efficient that it is still studied in business schools today. Throughout the 1990s and 2000s, Kohl's became the fastest-growing department store chain in the United States. The formula was beautifully simple: build a standalone, single-story box on a suburban road, stock it with recognizable national brands at lower prices than traditional malls, and mix in highly profitable private label clothing lines designed in-house. To drive foot traffic, they pioneered constant percentage off coupons, paired with a layout designed to get customers in, paid, and out the door in under 20 minutes. Wall Street fell in love. The stock soared into the S&P 500, and the footprint exploded past 1,100 stores by the late 2000s. But by the 2010s, consumer habits shifted. Amazon rose to dominance, and foot traffic across American retail cratered. Kohl's tried to innovate to stay relevant. They signed exclusive celebrity fashion lines, including partnerships with Vera Wang, Lauren Conrad, and Jennifer Lopez. Later, they made a bold, counterintuitive move, partnering with Amazon to accept free Amazon returns directly inside Kohl's stores, hoping to convert return droppers into Kohl's shoppers. They also began rolling out Sephora beauty counters nationwide. The strategy kept the lights on, but the core retail model was beginning to crack under pressure. By 2022, Kohl's was still a massive operation, managing 1,170 stores, 82 million square feet of retail space, and roughly 97,000 employees. But hidden within its balance sheet was a massive real estate portfolio. The company owned 410 of its stores outright, leased 517, and operated another 238 where they owned the physical building but leased the underlying land. This meant Kohl's was just as much a real estate story as it was a retail story. But massive real estate assets only save a company if they can be converted into liquid cash when trouble strikes. Activist investors pressured the board to execute sale-leaseback deals, where a company sells its owned real estate for immediate cash and then rents those exact same buildings back from the buyer. While this injects quick cash into the business today, it saddles the company with permanent, expensive rent obligations tomorrow. When corporate raiders Acacia Research and Sycamore Partners both lobbed in takeover bids valuing Kohls at roughly $9 billion, or up to $65 a share, the board refused. They believed the company could turn things around on its own. But then, the macroeconomic environment shifted violently. The Federal Reserve initiated a series of aggressive interest rate hikes. As the cost of borrowing skyrocketed, external buyers could no longer afford their original offers. Bids fell from $65 to $53 a share, and eventually, the entire sale process collapsed. The window to exit had officially slammed shut. Facing intense anger from shareholders after the failed sale, the board turned to financial engineering. They announced a massive stock buyback program, deploying hundreds of millions of dollars to buy their own shares. While reducing the number of outstanding shares can artificially boost a stock price in the short term, that cash leaves the company forever. For debt holders and lenders, that was vital cash that could no longer be used to pay down debt or protect operations. By the end of 2022, the leadership ranks fractured. Longtime CEO Michelle Gass departed, and retail veteran Tom Kingsbury stepped in. He inherited a company strained by failed acquisitions, rising interest rates, aggressive cash burn from buybacks, and a retail strategy in decline. In 2023 and 2024, the rating agencies struck. S&P and Fitch downgraded Kohl's credit rating deep into BB territory. In the financial world, BB is considered junk status. The company's debt-to-profit ratio ballooned past 3-to-1, a threshold that signal flashes severe distress to institutional investors. These downgrades meant that borrowing new money would become prohibitively expensive, cutting off Kohl's from the very bond markets that had kept it afloat. By 2025, the retrenchment began in earnest. The company scheduled the closure of dozens of underperforming stores and critical fulfillment centers across 15 states, absorbing millions in liquidation costs. Then came the ultimate leadership crisis. A newly appointed CEO was abruptly fired for cause following an internal investigation into an undisclosed personal conflict of interest involving corporate suppliers. The executive was forced to forfeit millions in bonuses, and the sudden vacuum left corporate creditors deeply unnerved. The cautionary tale of Kohl's provides 4 critical lessons for modern corporate business. First, massive assets can mask severe operational risks. Owning billions in real estate and thousands of storefronts cannot save a retailer if underlying sales continue to erode and leadership fractures. Second, real estate is not the same as liquid cash. Converting buildings into quick capital via sale-leasebacks creates permanent rent liabilities that take priority over corporate debt. Third, governance and corporate stability matter. Poison pills, boardroom civil wars, and rapid executive turnover destroy the foundational trust required by institutional lenders. Fourth, credit ratings and market perceptions often move too late. By the time rating agencies officially declared Kohl's debt as junk, the strategic errors had already been locked in years prior. Ultimately, the trajectory of Kohl's isn't just a story about changing consumer habits or the rise of e-commerce. It is a stark reminder that a company's survival doesn't depend on the tools it possesses, but on the order in which management chooses to use them.